In the final turbulent years of the 1970s, a story began to unfold. It was a story of immense wealth, of audacious ambition, and of a single, gleaming, precious metal: silver. At the center of this saga were two brothers, Nelson Bunker Hunt and William Herbert Hunt. They were the sons of Texas oil tycoon H.L. Hunt, inheritors of a fortune almost beyond comprehension. They were not men accustomed to small ventures or modest goals. They operated on a global scale, their decisions capable of moving markets and shaping economies. Their world was one of private jets, sprawling ranches, backroom deals that could alter the course of entire industries. The brothers held a deep-seated belief, a conviction almost ideological in its fervor. They saw the world teetering on the brink of economic chaos. Inflation was rampant, eroding the value of paper money. Political instability in the Middle East threatened the global oil supply and shook faith in traditional institutions. For the Hunts, the answer was not in stocks or bonds, but in something tangible, something real. They believed in hard assets, particularly precious metals like gold and silver. Their quest was not just to get richer, it was to protect their wealth from the collapse of the fiat currency system. This conviction led them to silver. Silver was undervalued and essential. It was critical for photography and industry, yet its price did not reflect its true worth. They began to buy it, not in small quantities, but with a voracious appetite the market had never seen. They started with physical bullion, storing tons in vaults in Switzerland and in the United States. Then they moved into the futures market, a more complex and ultimately more dangerous arena. Their goal: to corner the world's silver market, control its supply, and dictate its price. They were attempting to become the market. This was more than a financial bet. It was a crusade. They saw themselves as financial patriots, fighting government-printed money. They thought driving up silver's price would restore honest value and expose the US dollar's weakness. Their actions, however, were viewed very differently by others: regulators, jewelers, industrial users, small-time speculators. To them, it was unprecedented manipulation, a dangerous game that could bring the financial system to its knees and create a crisis of epic proportions. The brothers' buying began quietly, but its effect was undeniable. The price of silver, which had hovered around $6 an ounce for some time, began a slow and steady climb. With each massive purchase, the available supply dwindled, and the price ticked upward. This initial rise was subtle enough to be mistaken for a normal market trend, fueled by the general economic anxiety of the era. Investors, seeing the price move, began to join in, adding their own buying pressure to the momentum the Hunts had already created. The brothers were the unseen engine, driving a train that was slowly but surely gaining speed, and more passengers were hopping aboard for the ride. By the autumn of 1979, the climb was no longer slow or steady. It had become a frantic, almost vertical ascent. The price of silver rocketed from $9 an ounce in September to an astonishing $32 by December. The market was in a frenzy. News stories began to circulate about the immense, shadowy buyers who were dominating the silver trade. The names Hunt and silver became inextricably linked. Everyday people, lured by tales of easy fortunes, began selling their family silverware, their silver coins, and their jewelry, hoping to cash in on the unprecedented boom. The market had taken on a life of its own, fueled by a mixture of greed, speculation, and genuine fear. The peak of this madness arrived in January of 1980. The price of silver briefly touched an all-time high of $50 an ounce. At this zenith, the Hunt brothers' silver holdings, both in physical bars and in futures contracts, were valued at an estimated $4.5 billion. They had, for a moment, achieved their goal. They controlled a staggering amount of the world's known silver supply, perhaps as much as 2/3 of all the privately held bullion on the planet. The numbers were astronomical, difficult to grasp. They had bent the global market to their will through sheer financial force, creating a silver bubble of historic proportions. This meteoric rise, however, was built on a fragile foundation. The price was no longer connected to the metal's industrial or practical value. It was a price born of pure speculation, driven by the Hunt's relentless buying and the public's subsequent panic. Jewelers like Tiffany & Co. took out full-page ads in newspapers, decrying the unconscionable price of silver, which was crippling their businesses. Industrial users, from film manufacturers to electronics companies, were facing a supply crisis. The world watched with a mixture of awe and terror, wondering not if, but when, this glittering silver tower would come crashing down. To understand how the Hunts were able to amass such a vast position, one must understand the concept of leverage. When they bought physical silver bars, they had to pay the full price in cash. But in the futures market, things worked differently. A futures contract is a promise to buy or sell something at a future date for a predetermined price. To enter into such a contract, a buyer doesn't need to put up the full amount. Instead, they only need to post a small fraction of the total value as a deposit. This deposit is known as the margin. It is a powerful tool. It allows a small amount of capital to control a much larger position. The Hunt brothers used leverage to an extreme degree. For every dollar of their own money they put down as margin, they could control $10 worth, $20 worth, or even more dollars worth of silver. As the price of silver climbed, the value of their contracts ballooned, and so did their paper profits. This created a powerful feedback loop. Their growing profits allowed them to secure more loans, which they then used to buy even more silver futures, pushing the price higher still. They were essentially using the market's own momentum, which they had created, to finance their continued acquisition. It was a brilliant but incredibly risky strategy. The danger of leverage, however, is that it works in both directions. While it magnifies gains, it also magnifies losses. Section 4. The rules of the game. The exchange fights back. The commodity exchanges, primarily the COMEX in New York, and the Chicago Board of Trade, were growing increasingly alarmed. The Hunt's stranglehold on the silver market was causing extreme price moves. It was threatening the integrity of the exchanges themselves. An exchange acts as a middleman, guaranteeing that every trade will be honored. If a massive player like the Hunts were to default on their obligations, the exchange would be on the hook, triggering a chain reaction across the financial system. Regulators realized they were no longer watching a market. They were watching a hostage situation. In response, the exchanges began to change the rules of the game, taking direct aim at the Hunt's strategy. On January 7, 1980, the COMEX announced new restrictions. They placed limits on the number of contracts any single entity could hold. Limits applied to an individual trader, and to larger groups or firms as well. Most critically, they raised the margin requirements substantially. Holding a silver futures contract suddenly became much more expensive. The small deposit that was once required was now a much larger one. For speculators with small positions, it was an inconvenience. For the Hunt brothers, who held tens of thousands of contracts, it was a financial earthquake. The most devastating blow came shortly after. The exchange announced a new rule known as liquidation only. Traders could no longer establish new long positions in silver futures. They could only sell existing ones. The rule effectively turned the silver market into a one-way street. The door to get in was now locked. The only door open was the one leading out. This masterstroke by the exchanges completely cut off the Hunt's ability to keep pushing the price higher. They could no longer buy more contracts to support the price. The upward momentum they had engineered was brought to a dead stop. The brothers were trapped. Section 5. Silver Thursday, the inevitable collapse. With the new rules in place, the price of silver began to slide. It was a slow bleed at first. Peak, $50 an ounce in January. By mid-March, around $30, but the downward pressure was relentless. For the Hunt brothers, this triggered a cascade of margin calls. A call for $100 million, another margin call, and another. They scrambled to meet them, selling off other assets, securing massive loans. One loan from a consortium topped $1 billion. They were hemorrhaging cash, trying to plug a hole in a dam. The breaking point arrived on Thursday, March 27, 1980, a day forever known as Silver Thursday. That day, the Hunts failed to meet a margin call for over $100 million. The news hit the market like a thunderclap. Bach Halsey Stewart Shields faced a solvency crisis. To save itself, Bach began to liquidate the Hunts' massive silver position. They dumped huge sell orders onto the market, not at a negotiated price, but at whatever price they could get. It was a fire sale of historic proportions. The effect was instantaneous and catastrophic. The price of silver plummeted. In hours, it crashed by more than 50%, from over $21 an ounce to below $11. Panic swept through financial markets. The Dow Jones dropped sharply. Traders on the floor screamed, faces of disbelief. The system was seizing up. Fear moved beyond silver. It was about systemic stability. A default by the Hunts could bring down brokerages, which could bring down banks. The crash threatened a systemic crisis. The federal government and industry leaders intervened. In tense closed-door meetings, a bailout was arranged. A consortium of banks, encouraged by the Fed, extended a $1.1 billion line of credit, not to save the brothers, but to save the system. The loan let them pay immediate debts in an orderly way, preventing a domino-like collapse of brokerages and banks. The immediate crisis was averted, but the meltdown left a deep, permanent scar on the markets. Section 6. The Aftermath. A landscape of ruin. In the wake of Silver Thursday, the full extent of the devastation became clear. The Hunt brothers' personal fortune was shattered. While they avoided immediate bankruptcy thanks to the bailout loan, their silver empire was gone. The billion-dollar loan required them to pledge nearly all of their assets as collateral. Oil and gas fields, real estate, prized racehorses. Their wealth, once measured in the billions, had evaporated in the silver crash. They spent the next decade mired in lawsuits, congressional hearings, investigations by regulatory bodies. The crusade to restore honest money had ended in personal and financial ruin. Countless small speculators who had jumped on the silver bandwagon were wiped out. Many had used their life savings. Some had taken out second mortgages on their homes to buy silver at the peak. They watched its value collapse. Brokerage firms that had heavily financed the Hunts suffered massive losses. Some narrowly avoided insolvency. The event sent a shockwave of fear through the investment community. The regulatory consequences were profound. The Commodity Futures Trading Commission faced intense scrutiny. The event highlighted the dangers of excessive leverage and market cornering, spurring stricter position limits and more dynamic margin requirements. Ultimately, the brothers were held to account. In 1988, a federal jury found that Nelson Bunker, William Herbert, and Lamar had illegally conspired to corner the silver market. They were ordered to pay hundreds of millions and were eventually forced into personal bankruptcy. Section 7. Echoes in the Market. The Enduring Lessons of the Silver Crash. The story of the 1980 silver meltdown is more than a dramatic tale of a family fortune won and lost. It stands as a timeless and sobering lesson for every investor, from the largest institution to the smallest individual. The first and most critical lesson is about the immense danger of leverage. Leverage can amplify gains on the way up, and it will mercilessly amplify losses on the way down, leading to ruin with breathtaking speed. No market can defy gravity forever. Prices detached from value form a speculative bubble, and bubbles are inherently unstable. Markets do not operate in a vacuum. Rules and oversight exist to ensure fairness and prevent systemic collapse. When actions threaten the structure fights back. It can change the terms of engagement. In the end, the Hunt brothers' bet failed. The gleam of silver that captivated them reflected their downfall. Echoes of Silver Thursday are a permanent warning. Risk can never be eliminated, and the market's memory is very, very long.